While national GDP and the stock market suggest a highly robust economy, at the ground level, household cash flow is freezing up. Total U.S. credit card debt has now reached $1.39 trillion. This chart shows U.S. credit card balances from 1999 to present. After a decade of steady growth, balances take a 66% vertical jump. Now 111 million Americans are trapped in revolving debt, unable to pay off their cards each month. This is frequently framed as a low-income issue, but the data points elsewhere. Even in high-earning states like Connecticut and California, the average borrower is carrying a balance of nearly $10,000. The strong top-line economic statistics are effectively masking a widespread solvency crisis. Nearly half of the adult population in the U.S. owes more on their plastic today than at any point in history. High credit card debt usually conjures images of reckless spending, vacations, designer clothes, dining out. Today, that swipe happens at the pharmacy counter. While median wages have largely stagnated over the last few years, the cost of shelter, food, and basic transportation has rapidly climbed. Because of this widening gap, 41% of Americans say sudden emergency costs are the leading reason they go into debt. Unavoidable expenses like medical bills and home repairs act as the primary catalysts for insolvency, and it has normalized day-to-day borrowing. A full third of all debtors now cite basic utilities, childcare, and groceries as the primary reason they are carrying a balance. Economists are calling this conspicuous survival. People are no longer swiping to get ahead or live in luxury. They are mathematically forced to borrow just to keep from falling behind. Once a balance carries over, minimum payments are swallowed by interest. A decade ago, average APRs were 12%. Today, they frequently exceed 22%. This is interest rate stickiness. Banks raise rates immediately, but when the Fed cuts rates, consumer rates remain artificially high. This widening spread is known in economic circles as the Trump premium. By keeping borrowing costs high for consumers while their own costs fall, credit issuers doubled their profit margins since 2007. On top of traditional credit, there is now a $70 billion secondary market called Buy Now, Pay Later. These services split purchases into smaller installments, but they rarely report to credit bureaus, hiding massive amounts of phantom debt from the system. Between climbing APRs and phantom debt, American families have paid $2.1 trillion in interest alone since 2010. The math is designed to make breaking even virtually impossible. We saw exactly how fragile this baseline is during the 43-day federal government shutdown in late 2025. Missing just a single pay cycle triggered a collections domino effect. Hundreds of thousands of households transitioned into permanent delinquency because they simply had no savings to absorb a 40-day income pause. As basic lifelines were suspended, short-term delinquencies spiked within 30 days. People engaged in desperate survival borrowing, putting rent and groceries on high-interest plastic just to stay afloat. The retail banking sector didn't offer relief. Instead, banks drastically tightened their lending standards, lowering credit limits and cutting off escape routes like balance transfer cards for anyone showing signs of stress. The shutdown proved that the modern household operates with zero cash buffer. The functioning consumer economy relies entirely on an uninterrupted, highly precarious cycle of compounding debt. The psychological toll of this financial paralysis is staggering. Surveys show chronic debt is forcing millions to indefinitely delay having children, getting married, or investing for retirement. Seeing this, younger Americans are altering their life paths to avoid the trap. 60% of Gen Z workers now plan to skip debt-heavy college degrees entirely, pivoting instead to skilled blue-collar trades and tech-integrated labor. Corporate profits and stock indexes remain high, yet consumer bankruptcy filings have seen a sustained double-digit surge. $1.39 trillion in credit card debt is not a symptom of bad individual habits or sudden mass irresponsibility. It is the result of a perfectly functioning system designed to extract wealth from the American middle class.